Let us see next question. The following summarizes the percentage change in operating income, that is EBIT, percentage change in revenue, that is sales, and highlight the portion beta for 4 pharmaceutical firms. So we have been provided with information about percentage change in sales, percentage change in operating income, and beta information. Name of the companies provided to us: PQR, RST, TUV, WXY. Percentage change in revenue is given, percentage change in EBIT is given, and beta information is given. You are required to calculate degree of operating leverage, that is technically called DOL, for each of these firms. So for all the 4 companies we are required to find DOL. Comment also. Use operating leverage to explain why these firms have different beta. So there is a new term which is provided to us in the question, that is beta. How we are supposed to use it, that is also what we are going to discuss in this question. Please go through the question, all of you. Dear students, in this question, for the purpose of calculation of DOL, we cannot apply the formula as contribution upon EBIT. What is the reason? The reason behind that is sufficient information is not given so that we can apply this formula. So instead of this formula, we have to compute the DOL by using the formula percentage change in EBIT upon percentage change in sales. That is the way we can apply the DOL formula. So over here, we can make the calculation like this. I request all of you to write down answer along with me. DOL, it is percentage change in EBIT upon percentage change in sales. So basically for PQR it will be like this: 25 upon 27. For RST it is 32 divided by 25. For TUV it is 36 divided by 23. And for WXY it is 40 divided by 21. That is the way answer is supposed to be found. So 25 upon 27, 0.9259. That comes to 0.93. 32 upon 25. So it is 1.28. 36 upon 23. 1.57. 40 upon 21. 1.90. At the same time, we can mention the beta. Security PQR has beta 1, then 1.15, 1.13, 1.40. These are the values of the beta. I request all of you to calculate, that is a copy answer from the working. So friends, in the first part of the question speaks that you are required to calculate DOL, that is what we have done, and at the same time we are required to pass comment. The second part of the question is the same, that you are required to use DOL to explain Why these firms have different beta? So these two are the same things. So second part of the question, its answer will be calculated like this. I'm sorry, we are required to give the answer in this way. To explain that, I take a small example like this. You don't have to write anything, let me explain you. Suppose you have an amount of rupees 10 lakhs available for investment. You have told me to find a good business opportunity. So you have an amount of rupees 10 lakhs and you have told me that, sir, I'm interested to invest this 10 lakh rupees in a business. You just tell me if at all you have any such kind of business opportunity. Let us assume that State Bank of India has a rate of interest of 8%. Let us say that on 1st of January, I come to your residence and I tell you that say there is a project in which say you can make investment. The project is say about manufacturing of a product. I have explained to you that say how we are going to manufacture the product, how we are going to do the marketing of the product, how we are going to have the sales, expenses, all those things that I have explained it to you. After all the discussions that say I have made, you ask me one line question that, sir, what is the return that say I would be getting? I replied you that say you will get a return at the rate of 6%. My question to all of you is this. I request you to put your answer in the chat box that as an investor, would you like to make investment in this project or not? Give answer along with the reason. No answer is correct answer. Reason behind that is very simple. We understand that say making investment in this will give return at the rate of 6% and State Bank of India is giving so the return at the rate of 8%. So you will offer me a cup of tea and you will tell me that, sir, I am not interested in this business that is business proposal. I said okay. Again after 15 days I come to your residence wherein again I tell you something like this. Let's say there is a project for manufacturing and selling a product. And so on, I shared all the story with you. Your one line question is that, sir, what is the rate at which I will be getting return? I replied you that you will get a return at the rate of 8%. My question to you is that whether you will make investment in this investment proposal or not, give answer along with the reason. Answer of the question is no. You will once again deny. You will tell me that, sir, please have a cup of tea and I am not interested in this investment proposal. This time I am asking you that say why you are not interested. Then you will have a reply like this. That, sir, you just imagine when I make investment in State Bank of India, say there is no risk. There is absolutely no risk when I make investment in State Bank of India. In comparison to that, when I make investment, say in this business proposal, it has an element of the risk. Because it has an element of the risk, that is the reason I am not satisfied with the return at the rate of 8%. So you deny that, say no, I am not interested over here. This is what we understand. See, what I want to tell you, friends, understand carefully. I want to tell you that, say, in order to take a decision whether to, say, make investment or not, we understand that, say, while doing business, you want a return which is more than, technically given a name as risk-free rate of return. The term risk-free rate of return means, as an investor, you don't have absolutely any risk when you make investment, say in State Bank of India or any state government or central government security. This is what we understand. So again, your answer is no. Again, I go back and I come to you once again after another 15 days on 31st of January. Again, I tell you some story regarding manufacturing and selling of a product. When I start my conversation with you, first of all, you stop me and you tell me that, sir, can you just share me that what is the rate at which I will be getting return? This time I replied you that you'll get a return at the rate of 15%. So you will tell me that, okay. So you just tell me about the project. Now I am interested to know about the project. Remember that, say, if at all the project is giving a return at the rate of 15%, immediately you will not be ready to make investment. Why? Because we understand that, say, of course 15% is more than 8%, that is risk-free rate of return. So you are interested to make investment, but that does not mean that, say, you will definitely make investment. We know, friends, that, say, there are a number of industries which are there in the market. There are a number of industries which are there in the market. For example, there is something like called pharma industry, then fast moving consumer goods industry, then it is automobile industry, then it is banking, public sector undertaking, and so on. That's, there are a number of businesses which are there. Whether all these businesses are having same level of risk or they have different level of risk. We understand, friends, that, say, all these businesses are having different level of risk. So the risk level will change like this. Since the risk level is different for the different kind of the businesses, so we do not have, say, the same required rate of return from all the projects. We do not have the same required rate of return from all the projects. We will be having, say, the required rate of return based on the risk which the project is having. Definitely from all the projects we require the return which is more than what State Bank of India is offering. However, say how much more, that depends upon the risk. Dear students, listen carefully. There is a model which is given a name as CAPM, that is called Capital Asset Pricing Model. There is a model called CAPM, Capital Asset Pricing Model. CAPM measures, say, the risk in the security. CAPM measures, say, the risk in any of the project, and it is measuring the risk in form of beta of the security, in terms of beta of the project. So over here, friends, we have been provided with the information that, say, what sort of the beta, what sort of the risk that each of the security has, say, over here. That is what, say, we have been provided over here. Now listen carefully what I am going to speak. We have discussed so far, as far as the leverage is concerned, leverage is also the measurement of risk. Leverage is measuring risk in terms of introduction of the fixed cost in the business. Leverage is introducing, say, is indicating that, say, what kind of risk that we have, say, in terms of the fixed cost. Let us say that this is the total cost, and out of that the company may have the fixed cost of this level, or the company may have the fixed cost of this level. Let us say it is FC1 and this is FC2. So the total cost is same. However, the fixed cost component may be different. Had the fixed cost component, listen carefully, had the fixed cost component is indicating more risk, and because of that, so the leverage will be more. Leverage of fixed cost 2 will be more than the leverage of fixed cost 1. What I want to tell you is that with the increase in the fixed cost, leverage increases, and with the increase in the leverage, risk also increases. I repeat that. See, leverage increases means risk increases. Leverage increases means risk increases. Beta increases means risk increases. So over here, what kind of comment that we are required to pass? We are required to pass a very simple comment that the leverage is the measurement of the risk. Beta is also the measurement of the risk. That is the reason with the increase in the leverage, beta increases. This is the way we are required to pass the comment. Dear students, in CAPM, beta is calculated by using a simple formula called covariance of security with market divided by variance of the market portfolio. Or otherwise, it can be calculated as correlation coefficient of the security with market into standard deviation of security divided by standard deviation of market portfolio. So beta can be calculated by either of the formula. There are some other formulas also. However, these are the two basic formulas that we have. You don't worry. You don't have to remember any of the formula. This is what I'm writing only for your understanding purpose. So write down answer of the second part of the question. Leverage is measurement of risk for introduction of fixed financial charges. Full stop. Similarly, beta measures risk in security slash project. Full stop. With the increase in leverage, beta increases. And with that, leverage also increases. Full stop. Friends, leverage may be any type of leverage. May it be DOL, may it be DFL, or may it be DCL, that we are going to understand later on, but all the leverage are measuring the effect of the fixed cost. So let us have understanding of the revision of the entire answer. First of all, we are required to find all. For that, so we have to apply the formula percentage change in EBIT upon percentage change in sales. So for each of the four companies, we are required to make all these calculations. That is what we have done. Then in the second part of the question says that so you are required to pass comment with the interrelationship between the leverage and beta. We can say that so with the increase in the beta, leverage increases. That is what we understand. So over here, basically the PQR is having the lowest leverage and lowest beta. WXY is having highest leverage and highest beta. That is what's the way we have the answer over here. Dear students, in CAPM, capital asset pricing model, you are going to understand the beta and its calculation at your CA final level.